Charitable gift annuities and charity tax deductions decoded. This video explains in simple language the subtleties of charitable gift annuities and charity tax deductions, giving you the keys to use either fiscal strategy to optimize your philanthropic donations while complying with tax laws. A must-see if you plan, for example, to donate money to your alma mater or a community charity in your area. Watch now. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. And if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about charitable gift annuities and charity tax deductions. What is an annuity? Let's just go back to the basics here. An annuity is a financial contract that you enter into with an insurance company. In essence, you purchase the contract for a specific amount of money, either through a lump sum or periodic payments. In exchange, the insurance company agrees to pay you a set amount on a recurring basis. Now, depending on the type of annuity you buy, you may begin receiving payments immediately or defer them to a later date. Typically, annuity benefits are payable until you die, but some plans only allow you to receive payments for a fixed amount of time. So you can have an annuity insurance company can say, listen, we'll pay you $2,000 every month for 10 years, or we'll pay you $2,000 every month until you die. Now, what are the types of annuities? Annuities are not one size fits all. You have multiple types of annuities out there, and they generally fall into one of the two categories. You have fixed annuities and variable annuities. So a fixed annuity, as the name implies, offers a guaranteed return of the principal you paid in, along with a minimum amount of interest. So your payments stay the same for the entire length of the contract, so you know exactly how much income you can expect. Certain fixed annuities may be indexed, which means that your returns are linked to a specific market index, such as the S&P 500. Now let's talk about the variable annuities. Now, those work a little differently. Typically, your principal investment is still guaranteed, but your returns are not. So when you invest in this type of annuity, you have the opportunity to choose your investments, and the better they perform, the higher your returns will be. Variable annuities have the best potential for growth, but they also tend to carry a higher degree of risk. So it's up to you to kind of choose what works for you. The good news is that you also have the ability to choose between an immediate annuity or a deferred annuity. So an immediate annuity starts paying off as soon as you make an initial investment, whereas deferred annuities don't pay off until later. If you are retired, for example, an immediate annuity might make more sense. Younger people, on the other hand, gravitate towards deferred annuities as a plan for the future. Fixed annuities are also categorized in some cases as either equity indexed or market value indexed based on how the interest is generated. Now let's talk about the pros and cons of annuities. Again, folks, here we're talking about charitable gift annuities and charity tax deduction, but I'm first trying to break down to you what the term annuity means. What are the pros and cons? What are the types that we have there? So the pros of annuities are you have guaranteed income on a regular basis in retirement. You have delayed taxes on earnings, lower investment risk, remember, and the annuity sometimes can even extend to a beneficiary. What are the disadvantages here? If you use an annuity as part of your retirement plan, you have to understand that lower risks means lower growth or less growth. You have contract limitations, which mean that you cannot pull out the principal. You have a chance that you don't risk break-even point if you don't live long enough. And fees in some cases can be high. So insurance companies really might charge you. Sometimes they charge very high fees. So you want to talk to your annuity rep or your insurance rep before making any decision. let's talk about the taxation of annuities. One of the things you want to consider before buying an annuity is how it may impact your tax situation. Now, generally, your earnings become taxable at your regular rate once you start making qualified withdrawals. That means you don't get the added benefits of being able to apply the lower capital gains tax rate, right? We know that capital gains right now, the tax rate is around 15%, whereas for regular income, you're talking the maximum can go all the way to 40%. So if you start receiving payments before age 59 and a half, you'll also get hit with an additional 10% early withdrawal penalty. One thing that's very important to remember is that if you see a significant amount of growth from your annuity investment, you could find yourself shelling out more taxes each year. So whether or not an annuity is a good fit really depends on your situation and on how much you already have saved and what your long-term retirement goals are, right? So the thing here is if your goal is to find a stable, predictable, consistent investment that offers some tax benefits, an annuity generally will be the best route to go. But again, this kind of decisions will have to be made in conjunction with the specialist. You want to sit down with someone who understands your situation. I'm only giving you here some general information about annuities, but for your particular situation, it's just always better to sit down with a professional and study all the options that you have. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're still having a conversation here around charitable gift annuities and charity tax deductions decoded. Now, if you love the clarity and the quality of the content so far, please consider subscribing to our channel and turn on the notification bell. We'll surely appreciate that. You want to be informed whenever we drop a new show. We do this every single day, rain or shine. Comment below, like this content, and share. What is a charitable gift annuity? So we've talked about what an annuity was. Now let's talk about a charitable gift annuity. Now, this charitable gift annuity allows a donor to make a donation and receive fixed annuity payments for the rest of their life. So either an individual or a couple can donate. So the charitable gift annuity serves as a contract between the donor and the charity. So what happens here is that the donor makes a large gift to a charity, usually in cash or stocks or bonds or other securities. However, some donate real estate or other large financial assets. As a result here, the donor can take a partial tax deduction for their donation. Meanwhile, the charity gives them a fixed stream of income for the rest of their life. Now, charitable gift annuity donors are usually older, retired, and looking for an additional income stream in retirement, with the added bonus of getting to donate to charity. Now, how does it really work in practice here? Many large nonprofit organizations offer what we're talking about here. They offer gift annuities, especially colleges and universities. So the first thing you want to know is to confirm that the group you want to donate to offers charitable gift annuities. So assuming they do, your next step is to make the sizable donation you have planned. Now, colleges and universities have set limits, so the minimum amount you can give to qualify for a charitable gift annuity is usually $5,000 or $10,000. Nonetheless, many charitable gift annuities are usually worth much more than that. Now, the charity then will set your gifts aside in a reserve account and invest it or puts it in an account that accrues interest. So you will receive a scheduled, consistent, fixed monthly or quarterly payout, usually supported by your original donation for the rest of your life. Now, after you die, the charity then gets to keep the rest of the gifts. All right. So this is really how it works. So you first talk to a college or university. So whenever you hear those universities and colleges, they have endowment funds. That's part of it, right? So you find a college that works for you, or university, hopefully your alma mater. You have stayed in contact with them. So you make a $1 million donation to them. They pay you something, and until you die, And after you die, they keep the rest. Now, what are the potential drawbacks here? Let's first talk about the benefits. The benefits that you get to give money to a charity and you get a steady, albeit small income for the rest of your life. However, most of the time you don't get any inflation protection with charitable gift annuities. With a regular annuity, as we talked about earlier before, the one that you buy from an insurance company or the one that you sign with an insurance company, you can often pay extra or receive smaller payments at first in exchange for inflation adjustment payments. So if you're going to receive payments for the next 20 or 30 years, the real value of a $1,000 annuity check will be a lot less than it is today. So the amount of money you get each month or quarter will typically depend on your age when you set up the annuity. So if you are relatively young and therefore likely to collect more payments, they will be smaller. However, if you're older and therefore likely to pass away sooner, the payments will be larger. So if a couple, say, sets up a charitable donation, the same process applies. The only exception here is that the charity must wait until both spouses pass away to receive the remainder of the gifts. Now let's talk about charitable gift annuities and taxes. Now, those who benefit from the annuity, they're called the annuitants. So the annuitants can take a tax deduction when they gave the original gifts. Now that deduction depends on the estimated amounts that will actually go to charity after all annuity payments are made. The charity will work with the annuity provider to estimate the donor's life expectancy. Right, that's one of the areas where you see a lot of actuaries doing a lot of work in terms of estimating the life expectancy of the annuitants. Depending on that estimate, the donor may receive partial annuity payments tax-free for a period of time. Now, the IRS has broken down the charitable gift annuity down into two components. So the first is a contribution to the charity, which the IRS views as a charitable donation, and that's true. This is what it is. We have a transfer of wealth from one private citizen to a nonprofit. So that's the first part. The second part, the donor investments generate payouts. So now, a charity may let you donate long-term appreciated stock or other property in place of cash, and that happens a lot. In that case, you can reduce or eliminate the capital gains you would pay if you sold this asset before donating the proceeds. The same applies if you donate, for example, long-term appreciated securities. I'm talking about stocks, bonds, ETFs, mutual funds, and so on and so forth, or personal property to any public charity that can accept them. However, part of your annuity income is taxable at the federal level. It's also taxable at state level if the state you live in has an income tax. If you're lucky to live in Alaska, you're cool. There's no sales tax. There's no income tax. So you always want to talk to a financial advisor or a CPA or an EA or a tax specialist who has experience with charitable gift annuities before you sign any documents. Now, as I said, this type of annuities, the charitable gift annuities, can help you donate to the charity or school of your choice. It's also financially beneficial through the tax break. However, remember that your payments are only as secure as the finances of the school or charity you're donating to. If the institutions, God forbid, goes bankrupt, your annuity disappears. So do your research. So you want to do your research beforehand. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation today around charitable gift annuities and charity tax deductions decoded. Now, what is a charity tax deduction? I know that we've been talking. I've been talking to you about charity tax, charity. I've been talking to you about annuity, charitable gift annuities, and now let's talk about charity tax deduction. How to claim a tax deduction for charitable giving. Now, the most important step to get your charitable tax deduction is to claim. You have to claim it. You have to claim the charitable donation on your taxes. So the IRS when you do this, this tells the IRS and state tax collecting agencies that you have given a charitable donation and that you qualify for a deduction. To claim the charitable tax deduction, you need to itemize your deductions, right? A lot of young people with relatively simple taxes just take standard deductions, but there's not an option if you're looking to take advantage of a charitable tax deduction, right? So you will list the charitable deduction on your tax return, and the money you donated to charity will be deducted from the total income you pay taxes on for that year. Remember, you can only claim a tax deduction for a charitable donation in the year you give the donation. Now, what qualifies as a charitable donation? So most donations to nonprofit organizations qualify for the charitable tax deduction. Now, some organizations that do count for the charity tax deduction include religious organizations like mosques, synagogues, and churches. You have charities. You have nonprofits organizations, including schools and volunteer emergency departments. You have veteran groups, public parks. You also have, now remember that there are some donations that you can never deduct on your tax returns, as the law currently says. So if you donations to social welfare and civic organizations registered under section 501c4, except for veteran groups and volunteer emergency departments, tickets to fundraising events or raffle tickets, donations directly to a family or a community member to help after a tragedy, like if you have a GoFundMe campaign, and if that campaign is not certified charity campaign, you cannot deduct that as a charity tax deduction. Now, the question here is that you need to keep records of your donation. Always make sure to keep records of your donations if you plan to take advantage of the charity tax deduction, because God forbid, if you're ever audited by the IRS, they will want to see those things. So the IRS accepts the following forms of proof for a charitable donation rather. So you have a canceled check, a credit card statement, a bank statement, a written proof from the charity. So if your charity is more than 250, you may also need to prove to the agency, to the authorities, that you did not receive anything in return for the donation, right? So you can meet that criterion very easily by asking the charitable organization to issue a statement. Now, is there a charitable donation limit? This is another thing that we want to talk about. The answer is yes. There is a limit to the amount of charitable donations you can deduct from your taxable income. Generally speaking, you cannot deduct more than 50% of your AGI, your adjusted gross income. This means that if you have a big bank account, you cannot get out of paying taxes entirely by giving the equivalent of your salary in donations. Now, there may be some cases where the limit is only 20 or 30%. So you want to talk to your tax attorney, your tax specialist, to your CPA, to your EA, enrolled agent, to see if that applies to you. Now, another thing is, if you donate non-monetary items, because this is something you can donate. You don't have to give cash. You can give more than that. You can give something else. You can also get the charity tax deduction if you donate those non-monetary items. This includes making donations of old clothes or housewares to charities like Goodwill or the Salvation Army, right? You can deduct the fair market value of the goods. The IRS only allows for deduction for donations of items in good condition. So if you are deducting more than $5,000 for non-monetary items, you'll need to attach a qualified appraisal to your tax return. So this is it, folks. Today's conversation was around charitable gift annuities and charity tax deduction. And quickly recap what we talked about here. So I explained to you what an annuity is, what a charitable gift annuity is, and what is a charity tax deduction. I hope you really enjoyed this conversation as much as I did, and I will see you next time. But until then, remember, stay charitable.